Question 1. Market research demonstrates that while brokers often facilitate reinsurance placements, the precise moment and manner of contract formation can be a point of contention. A ceding company believes it has secured reinsurance coverage based on a broker's communication of a reinsurer's tentative agreement and subsequent placement of facultative certificates. However, the reinsurer later denies coverage, stating that no formal binding agreement was ever executed and that the broker exceeded their authority. The ceding company seeks to enforce the coverage. Which of the following approaches best reflects the principles of contract formation and interpretation within the regulatory framework governing reinsurance in this jurisdiction? Option A. The ceding company should accept the reinsurer's denial and seek alternative reinsurance, as the absence of a formal, signed agreement means no contract was legally formed, regardless of the broker's communications or the issuance of certificates. Option B. The ceding company should rely solely on the industry custom of brokers binding reinsurers through verbal assurances and preliminary documentation to establish the existence of the contract, as this is standard practice in the market. Option C. The ceding company should review all correspondence and documentation exchanged between itself, the broker, and the reinsurer to determine if a clear offer and acceptance occurred, and if the terms of coverage were sufficiently defined to constitute a binding contract, considering the broker's apparent authority. Option D. The ceding company should proceed with legal action to enforce the coverage, arguing that the broker's actions and the issuance of facultative certificates constitute a binding agreement by implication and custom, overriding the reinsurer's denial. Correct answer is D. The ceding company should proceed with legal action to enforce the coverage, arguing that the broker's actions and the issuance of facultative certificates constitute a binding agreement by implication and custom, overriding the reinsurer's denial. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of reinsurance contract formation and interpretation, specifically concerning the implications of a broker's actions and the potential for implied terms. The challenge lies in determining whether a binding contract was formed, what its terms are, and what recourse is available when a dispute arises, all within the confines of the specified regulatory framework. Careful judgment is required to avoid misinterpreting industry practices or legal precedents, which could lead to significant financial and reputational damage. The correct approach involves a thorough review of the communications and actions of both the reinsurer and the ceding company, as facilitated by the broker, to ascertain if the essential elements of contract formation, offer, acceptance, consideration were met. This includes scrutinizing the broker's authority and the intent of the parties as evidenced by their conduct. Interpretation of contract terms should focus on the explicit language used, but also consider industry custom and practice where ambiguity exists, always adhering to the principles of good faith and fair dealing mandated by the regulatory framework. Remedies for breach must be sought in accordance with the contract's dispute resolution clauses and applicable law. This approach is correct because it prioritizes a legally sound and contractually compliant resolution, minimizing the risk of litigation and upholding the integrity of the reinsurance relationship. It aligns with the regulatory emphasis on clear contractual terms and fair practices in the insurance and reinsurance markets. An incorrect approach would be to assume a contract exists solely based on the broker's assurances without verifying the reinsurer's formal acceptance or the clarity of the terms. This fails to acknowledge the legal requirements for contract formation and could lead to disputes over coverage and liability. Another incorrect approach is to rely solely on industry custom to fill significant gaps in the written agreement, especially if the contract explicitly states that it constitutes the entire agreement and supersedes prior discussions. This ignores the principle that written contracts are paramount and can lead to misinterpretations of the parties' actual intentions. A third incorrect approach is to immediately pursue legal action for breach without first attempting to resolve the dispute through the contractually agreed-upon methods, such as arbitration or mediation. This can be seen as a failure to act in good faith and can incur unnecessary costs and damage business relationships, potentially violating regulatory expectations for efficient dispute resolution. Professionals should employ a decision-making framework that begins with a meticulous review of all documentary evidence and communications. This should be followed by an objective assessment of whether the legal requirements for contract formation have been satisfied. If a contract is deemed to exist, the next step is to interpret its terms, giving primary consideration to the written word, and then, if necessary, to industry practice and custom, always in a manner consistent with the overarching principles of good faith. Finally, any proposed remedies for breach should be evaluated against the contract's provisions and the applicable regulatory framework, prioritizing a commercially sensible and legally defensible resolution. Question 2. What factors determine the appropriate method for calculating and adjusting reinsurance premiums, considering the specific terms of the reinsurance contract and relevant regulatory guidelines? Option A. The reinsurer's internal cost of capital and desired profit margin, irrespective of the specific contract terms. Option B. The prevailing market rates for similar reinsurance contracts, regardless of the specific terms of the existing agreement. Option C. The ceding company's immediate cash flow needs and the reinsurer's willingness to offer flexible payment schedules without explicit contractual basis. Option D. The agreed-upon calculation methodology in the reinsurance contract, the stipulated payment terms, and the contractual provisions for premium adjustments based on factors like claims experience or changes in the underlying business. The correct answer is D. The agreed-upon calculation methodology in the reinsurance contract, the stipulated payment terms, and the contractual provisions for premium adjustments based on factors like claims experience or changes in the underlying business. Explanation: this scenario is professionally challenging because it requires a reinsurer to navigate the complexities of premium calculation and payment terms in a way that is both compliant with regulatory requirements and fair to the ceding company, while also managing the reinsurer's own financial risk. The core challenge lies in balancing the need for accurate premium accrual against the practicalities of payment schedules and potential future adjustments, all within the confines of the applicable regulatory framework. Careful judgment is required to ensure that the chosen methods align with the spirit and letter of the law, preventing disputes and maintaining a sound financial position for both parties. The correct approach involves a thorough understanding and application of the premium clause, as defined by the reinsurance principles and practices exams governing regulatory framework. This approach prioritizes adherence to the specific calculation methods agreed upon in the reinsurance contract, such as gross premium, net premium, or a combination, and ensures that payment terms are clearly stipulated and consistently applied. Furthermore, it necessitates a robust process for managing premium adjustments, whether they arise from changes in the underlying business, claims experience, or other contractually defined triggers. Regulatory justification for this approach stems from the fundamental principles of transparency, accuracy, and financial soundness mandated by the regulatory body overseeing reinsurance. Adherence to agreed-upon calculation methods and payment terms prevents misrepresentation and ensures that the reinsurer receives appropriate compensation for the risk assumed, while also allowing the ceding company to manage its liabilities effectively. Proper handling of adjustments safeguards against under- or overpayment, maintaining the integrity of the reinsurance arrangement, and complying with solvency and reporting requirements. An incorrect approach that focuses solely on the initial premium payment, without adequately considering future adjustments or the specific calculation methodology stipulated in the contract, fails to uphold the principle of accurate financial reporting and risk transfer. This can lead to regulatory scrutiny for misstating liabilities or assets. Another incorrect approach that prioritizes expediency over contractual clarity in payment terms. For instance, by accepting late payments without proper documentation or recourse, exposes the reinsurer to financial risk and potential noncompliance with internal controls and regulatory expectations regarding prudent financial management. A third incorrect approach that ignores or inadequately addresses the triggers for premium adjustments, such as changes in the underlying portfolio's risk profile, can result in significant financial discrepancies and disputes, potentially violating the contractual obligations and leading to regulatory sanctions for failing to manage reinsurance arrangements appropriately. Professionals should employ a decision-making framework that begins with a comprehensive review of the reinsurance contract's premium clause, identifying the agreed-upon calculation methods, payment schedules, and adjustment provisions. This should be followed by an assessment of the current business and claims experience to determine if any adjustments are warranted. All actions taken must be documented meticulously and cross-referenced with the regulatory guidelines to ensure full compliance. This systematic process, grounded in contractual understanding and regulatory adherence, ensures that premium calculations and payments are accurate, timely, and transparent, fostering trust and stability in the reinsurance relationship. Question 3. Examination of the data shows a dispute arising from a reinsurance contract where a specific clause, initially appearing straightforward, has led to differing interpretations regarding a large claim. The Sedent argues that the clause, when applied to the facts, clearly covers the claim. The reinsurer contends that the clause, despite its wording, was not intended to cover such a scenario and that their interpretation should prevail. The Sedent has presented evidence of industry practice that supports their interpretation, while the reinsurer has not introduced any external evidence but relies on their understanding of the clause's intent. Which approach to contract interpretation is most appropriate in resolving this dispute, considering the potential for ambiguity and the typical regulatory environment for reinsurance? Option A. Focus on the initial, seemingly plain meaning of the clause and dismiss any arguments of ambiguity raised by the Sedent, without considering the contra pro frontum rule or industry practice. Option B. Interpret the clause solely based on the reinsurer's understanding of its intended meaning, disregarding any industry practice presented by the Sedent. Option C. Introduce extrinsic evidence to support the reinsurer's interpretation, even if it contradicts the literal wording of the clause, and ignore the contra pro frontum rule. Option D. Prioritize the plain meaning of the clause, and if ambiguity exists, apply the contra pro frontum rule to interpret the clause against the reinsurer, while respecting the limitations of the parallel evidence rule. The correct answer is D. Prioritize the plain meaning of the clause, and if ambiguity exists, apply the contra pro frontum rule to interpret the clause against the reinsurer, while respecting the limitations of the parallel evidence rule. Explanation. This scenario presents a professional challenge due to the inherent ambiguity in contractual language, a common occurrence in reinsurance. The core difficulty lies in interpreting a clause that, on its face, appears clear but leads to conflicting outcomes when applied to the specific circumstances of the claim. This necessitates a careful and principled approach to contract interpretation to ensure fairness and adherence to regulatory expectations. The correct approach involves prioritizing the plain meaning of the words used in the reinsurance contract, as this is the foundational principle of contract interpretation. If the language is unambiguous, it should be applied as written. However, when ambiguity arises, as it does here, the contra pro frontum rule becomes critical. This rule dictates that any ambiguity in a contract should be interpreted against the party that drafted it. In the context of reinsurance, this often means interpreting ambiguities against the reinsurer, who typically prepares the contract. This approach aligns with regulatory principles that aim to protect the Sedent and ensure that reinsurers do not benefit from poorly drafted or misleading contract terms. The parallel evidence rule, while relevant to contract interpretation, is generally applied to exclude extrinsic evidence that contradicts or varies the terms of a written contract intended to be the complete agreement. In this specific situation, the focus is on interpreting the existing written terms, not on introducing external evidence to alter them. An incorrect approach would be to solely rely on the initial, seemingly plain meaning without considering the context or the implications of the ambiguity. This fails to acknowledge that plain meaning can be challenged by the practical application of the contract. Another incorrect approach would be to disregard the contra pro frontum rule and attempt to interpret the ambiguous clause in a manner that favors the drafting party, thereby undermining the principle of fairness and potentially violating regulatory expectations for equitable treatment of sedents. Furthermore, incorrectly applying the parallel evidence rule by attempting to introduce extrinsic evidence to alter the clear meaning of an unambiguous clause, or conversely, by refusing to consider relevant context that clarifies an ambiguity, would also be professionally unsound. The professional decision-making process for similar situations should begin with a thorough review of the contract language. If ambiguity is identified, the next step is to consider the contra pro frontum rule and its application in the relevant jurisdiction. The intent of the parties, as evidenced by the contract itself and potentially by industry custom and practice, should be assessed. The parallel evidence rule should be applied to determine whether extrinsic evidence is admissible to clarify, rather than contradict, the written terms. Ultimately, the interpretation should be fair, reasonable, and consistent with the regulatory framework governing reinsurance. Question 4. When evaluating a cedent's request for an advance payment on a future claim settlement, Which of the following actions best reflects a reinsurer's commitment to compliance with its regulatory framework and contractual obligations? Option A. Consult with the cedent to understand how they would prefer the advance payment to be structured to meet regulatory requirements. Option B. Refuse the advance payment outright to conserve capital, without a detailed review of the contract or regulations. Option C. Conduct a thorough review of the reinsurance contract and applicable regulatory guidelines to determine if the advance payment is permissible and to ensure it does not compromise the reinsurer's solvency or reporting integrity. Option D. Immediately grant the advance payment to maintain a positive relationship with the cedent, assuming the financial impact will be manageable. The correct answer is C. Conduct a thorough review of the reinsurance contract and applicable regulatory guidelines to determine if the advance payment is permissible and to ensure it does not compromise the reinsurer's solvency or reporting integrity. Explanation: this scenario is professionally challenging because it requires a reinsurer to navigate potentially conflicting interests between its own financial stability and the regulatory obligations it has to its cedent. The reinsurer must ensure its compliance with the regulatory framework governing reinsurance operations in its jurisdiction, which typically includes solvency requirements, reporting obligations, and fair dealing with cedents. The core of the challenge lies in interpreting and applying these regulations when faced with a cedent's request that might strain the reinsurer's resources or create an appearance of impropriety. Careful judgment is required to uphold regulatory integrity while maintaining a sound business relationship. The correct approach involves a thorough review of the reinsurance contract and applicable regulations to determine if the cedent's request for an advance payment is permissible. This approach prioritizes adherence to the established legal and regulatory framework. Specifically, it requires the reinsurer to assess whether such an advance would violate any solvency requirements, capital adequacy rules, or provisions related to the proper accounting and reporting of reinsurance transactions. If the contract and regulations permit such an advance under specific conditions, and these conditions are met, then proceeding with the advance, with appropriate documentation and disclosure, would be compliant. This demonstrates a commitment to regulatory compliance and responsible financial management, ensuring that the reinsurer's actions do not jeopardize its ability to meet its obligations to all policyholders and stakeholders. An incorrect approach would be to immediately grant the advance payment without a proper review. This fails to uphold the reinsurer's duty to comply with its regulatory obligations. Such an action could lead to a breach of solvency requirements if the advance depletes capital below mandated levels, or it could be seen as an improper financial arrangement that distorts the reinsurer's financial position, potentially misleading regulators and other stakeholders. Another incorrect approach would be to outright refuse the advance payment solely based on a desire to preserve capital, without first consulting the reinsurance contract and relevant regulations. While capital preservation is important, a blanket refusal without due diligence might violate contractual terms or demonstrate a lack of good faith in dealing with the cedent, potentially leading to disputes and reputational damage. This approach neglects the contractual relationship and the possibility that the advance might be permissible and beneficial under certain circumstances. A third incorrect approach would be to seek advice from the cedent on how to structure the advance payment to appear compliant. This is ethically unsound and a clear violation of regulatory principles. The reinsurer has an independent obligation to ensure its own compliance, and seeking guidance from the party requesting the transaction, especially on how to circumvent or obscure regulatory requirements, creates a significant conflict of interest and undermines the integrity of the regulatory oversight. The professional decision-making process for similar situations should begin with a clear understanding of the contractual obligations and the governing regulatory framework. The reinsurer must then objectively assess the cedent's request against these established rules. If there is ambiguity, seeking clarification from legal counsel specializing in reinsurance and regulatory compliance is crucial. Transparency and thorough documentation of all decisions and actions are paramount to demonstrating good faith and adherence to regulatory standards. Question 5. The evaluation methodology shows that a reinsurer is reviewing a facultative reinsurance contract with an arbitration clause. The clause states that disputes will be settled by arbitration in London, with each party appointing one arbitrator and the two arbitrators appointing a third. However, The clause is silent on the process if the parties cannot agree on their respective arbitrators, or if the two appointed arbitrators cannot agree on a third. Furthermore, the clause broadly states that all disputes arising out of or in connection with this contract are subject to arbitration, but it does not explicitly carve out any specific types of disputes. The reinsurer needs to assess the effectiveness and enforceability of this arbitration clause. Which of the following assessments best reflects the potential challenges and best practices for this arbitration clause under typical UK/SISI regulatory frameworks for reinsurance? Option A. The clause is highly effective as the parties have agreed to arbitration in London, and the scope of disputes is comprehensive, ensuring all matters are covered. The method of arbitrator appointment is standard and unlikely to cause issues. Option B. The clause is problematic because London is not a signatory to the New York Convention, and the broad scope of disputes is too vague, potentially leading to overreach by the arbitrators. The arbitrator appointment process needs to be more detailed. Option C. The clause is robust because London is a well-established arbitration seat, and the broad scope of disputes is advantageous. The silence on arbitrator appointment is a minor issue that can be resolved by referring to institutional rules if a specific body was named. Option D. The clause presents significant enforceability risks due to the lack of a clear mechanism for arbitrator appointment, which could lead to deadlock and procedural challenges. The broad scope of disputes, while generally positive, might be challenged if it inadvertently includes matters outside the parties' intent to arbitrate. The correct answer is C. The clause is robust because London is a well-established arbitration seat, and the broad scope of disputes is advantageous. The silence on arbitrator appointment is a minor issue that can be resolved by referring to institutional rules if a specific body was named. Explanation. This scenario is professionally challenging because it requires a reinsurer to navigate the complexities of international arbitration clauses within a reinsurance contract, specifically concerning the selection of arbitrators, the defined scope of disputes subject to arbitration, and the practicalities of enforcing an arbitral award. The challenge lies in ensuring compliance with the chosen arbitration framework, which is typically governed by the contract's terms and potentially by the laws of the seat of arbitration and the enforcing jurisdiction. Misinterpreting any of these elements can lead to protracted legal battles, increased costs, and an inability to resolve disputes effectively, undermining the core purpose of the arbitration clause. The correct approach involves a thorough understanding of the arbitration clause's specific wording regarding arbitrator selection, ensuring it aligns with established best practices and any mandatory legal requirements of the chosen seat of arbitration. This includes verifying that the process for appointing arbitrators is fair, impartial, and efficient, and that the arbitrators possess the necessary expertise in reinsurance. Furthermore, the scope of arbitration must be clearly defined to encompass all potential disputes arising from the reinsurance contract, avoiding ambiguity that could lead to jurisdictional challenges. Finally, the approach must consider the enforceability of awards, often by selecting a seat of arbitration that is a signatory to the New York Convention on the recognition and enforcement of foreign arbitral awards, and ensuring the arbitration process itself adheres to due process standards. This meticulous attention to detail ensures that the arbitration clause functions as intended, providing a predictable and effective dispute resolution mechanism. An incorrect approach that fails to specify a clear process for arbitrator selection, leaving it to ad hoc agreement without a fallback mechanism, risks deadlock and delays, potentially leading to disputes over the arbitration process itself. This can violate the implied duty of good faith and fair dealing in contract performance, and may contravene procedural rules of arbitration bodies if a specific institution is referenced. Another incorrect approach that defines the scope of arbitration too narrowly, excluding critical issues like coverage disputes or claims handling, would render the arbitration clause ineffective for many common reinsurance disputes, forcing parties into potentially less efficient court litigation. This failure to adequately scope the arbitration clause undermines the parties' intent to resolve disputes efficiently. A third incorrect approach that selects a seat of arbitration in a jurisdiction not party to the New York Convention, or one with a history of non-enforcement of foreign awards, significantly jeopardizes the enforceability of any resulting award, making the arbitration process a Pyrrhic victory. This demonstrates a lack of due diligence regarding the practical implications of the chosen arbitration framework, Professionals should adopt a decision-making process that prioritizes a comprehensive review of the arbitration clause in conjunction with the entire reinsurance contract. This involves identifying the governing law of the contract and the potential seat of arbitration, and then researching the arbitration laws and conventions applicable to those jurisdictions. When drafting or reviewing arbitration clauses, professionals should seek clarity and specificity in all aspects, particularly regarding arbitrator appointment, the scope of arbitrable disputes, and the procedural rules that will govern. Consulting with legal counsel specializing in international arbitration and reinsurance is crucial to ensure the clause is robust, enforceable, and aligns with the parties' commercial objectives. Question 6. Governance review demonstrates that a reinsurance broker has proposed an excess of loss reinsurance program for a specialty insurer. The insurer has requested very high attachment points and relatively low limits, citing a desire to minimize upfront premium costs. The broker has not conducted a detailed analysis of the insurer's historical loss data or its projected future loss development trend, nor has it fully explained the implications of the proposed reinstatement provisions on coverage availability and cost after a loss. What is the most appropriate course of action for the reinsurance broker to ensure regulatory compliance and fulfill their professional obligations? Option A. Inform the insurer that the proposed structure is acceptable but recommend they seek independent actuarial advice to validate the attachment points and limits, thereby shifting the responsibility for risk assessment. Option B. Agree to the proposed structure, but include a clause in the reinsurance contract that explicitly states the insurer accepts full responsibility for any inadequacy in coverage due to the chosen attachment points and limits. Option C. Proceed with the insurer's requested attachment points and limits, as the client has the ultimate authority to determine their desired coverage levels and focus solely on securing the most competitive premium. Option D. Advise the insurer that the proposed attachment points and limits are likely insufficient to adequately protect their balance sheet from significant loss events, and recommend a revised structure based on a thorough risk assessment, including a clear explanation of reinstatement provisions. The correct answer is D. Advise the insurer that the proposed attachment points and limits are likely insufficient to adequately protect their balance sheet from significant loss events, and recommend a revised structure based on a thorough risk assessment, including a clear explanation of reinstatement provisions. Explanation. This scenario presents a professional challenge because it requires the reinsurance broker to balance the client's desire for comprehensive coverage with the practicalities and regulatory implications of structuring an excess of loss reinsurance program. The core difficulty lies in accurately assessing and articulating the risk profile of the cedant to ensure the attachment points and limits are appropriately set, thereby avoiding both underinsurance and excessive premium costs, while also adhering to regulatory expectations regarding prudent risk management and disclosure. The correct approach involves a thorough, data-driven analysis of the cedant's historical loss experience, projected future losses, and the specific nature of the risks being underwritten. This analysis should inform the selection of attachment points and limits that provide meaningful protection without creating a moral hazard or being unduly expensive. Reinstatement provisions must be clearly understood and communicated, ensuring the client comprehends their impact on coverage availability and cost after a loss. Regulatory compliance is paramount. This includes ensuring that the proposed reinsurance structure aligns with solvency requirements and that all material aspects of the coverage are transparently disclosed to the cedant. The broker's duty of care extends to providing advice that is in the client's best interest, supported by a robust understanding of the underlying risks and the reinsurance market. An incorrect approach would be to simply accept the cedant's proposed attachment points and limits without independent verification or a deep dive into the underlying risk profile. This failure to conduct due diligence could lead to a reinsurance program that is either inadequate to protect the cedant from catastrophic losses or prohibitively expensive, thereby failing to meet the client's needs and potentially exposing them to financial distress. Such an approach could also violate regulatory principles of prudent risk management and the duty to provide suitable advice. Another incorrect approach would be to prioritize securing the largest possible reinsurance limit regardless of the cedant's actual risk exposure or financial capacity. This could result in a program with an excessively high limit and a correspondingly high premium, which is not cost-effective for the client. Furthermore, if the attachment point is set too high relative to the cedent's likely loss severity, the reinsurance may never respond, rendering it ineffective. This misrepresentation of value and potential ineffectiveness could be viewed as a breach of the broker's fiduciary duty and potentially contravene regulations requiring fair treatment of clients. A third incorrect approach would be to overlook or inadequately explain the implications of reinstatement provisions. If the client is unaware that their coverage may be exhausted and require additional premium to reinstate after a loss, they may face unexpected financial burdens. This lack of transparency and understanding regarding a critical feature of the reinsurance contract constitutes a failure in disclosure and advice, potentially leading to disputes and regulatory scrutiny. The professional decision-making process should involve a systematic evaluation of the cedent's business, risk appetite, and financial standing. This includes gathering and analyzing historical loss data, understanding the cedent's underwriting philosophy, and assessing the volatility and potential severity of their insured risks. The broker must then translate this understanding into appropriate reinsurance terms, including attachment points, limits, and reinstatement clauses, ensuring these are clearly communicated and understood by the client. Regulatory adherence, including solvency and disclosure requirements, must be integrated into every step of the process, ensuring the advice provided is both commercially sound and compliant. Question 7. Regulatory review indicates that a reinsurer's underwriting portfolio exhibits significant concentration in specific geographic regions prone to natural catastrophes. The reinsurer is seeking to refine its modeling techniques for event definitions, pricing considerations, and geographic diversification to ensure compliance with solvency and risk management regulations. Which of the following approaches best aligns with regulatory expectations for prudent risk assessment and pricing in this context? Option A. Utilizing a simplified modeling approach that aggregates diverse geographic areas into a few broad categories and applies generic event risk factors. Option B. Adopting a highly theoretical and complex modeling technique that requires extensive subjective assumptions due to limited granular data availability for specific event perils. Option C. Relying primarily on broad historical loss averages for natural catastrophes, aggregated across large geographic regions, without specific event peril definitions. Option D. Employing a catastrophe (CAT) modeling framework that utilizes granular geographic data, allows for the precise definition of relevant event perils, e.g., specific wind speeds, flood levels, and quantifies the impact of diversification across distinct geographic zones. The correct answer is D. Employing a catastrophe (CAT) modeling framework that utilizes granular geographic data allows for the precise definition of relevant event perils, e.g., specific wind speeds, flood levels, and quantifies the impact of diversification across distinct geographic zones. Explanation. This scenario presents a professional challenge because it requires the reinsurer to balance the need for accurate risk assessment and pricing with the practical limitations of available data and modeling capabilities, all while adhering to regulatory expectations for prudent underwriting and financial stability. The core difficulty lies in selecting an appropriate modeling technique that adequately captures the complexities of event definitions and geographic diversification without becoming overly speculative or computationally prohibitive. The correct approach involves utilizing a catastrophe (CAT) modeling framework that incorporates granular geographic data and allows for the definition of specific, relevant event perils. This method is professionally sound because it directly addresses the regulatory emphasis on understanding and quantifying exposure to specific, identifiable risks. By defining events precisely, e.g., hurricane wind speeds, earthquake magnitudes, flood zones, and mapping them to specific geographic areas, the reinsurer can more accurately assess the potential impact of a single event or a correlated series of events across its portfolio. This granular approach supports robust pricing by reflecting the actual risk concentration and the benefits of geographic diversification, ensuring that premiums are adequate to cover potential losses and maintain solvency, as mandated by regulatory principles of prudent risk management. An incorrect approach would be to rely solely on historical loss data without sophisticated event definition or geographic segmentation. This fails to adequately capture the potential for future, unprecedented events or the impact of climate change and evolving risk landscapes. Regulators would view this as a failure to conduct due diligence and a potential underestimation of risk, leading to inadequate pricing and capital allocation. Another incorrect approach would be to use a highly generalized modeling technique that aggregates geographic regions into broad categories and uses generic event definitions. While simpler, this approach masks significant variations in risk within those regions and fails to accurately reflect the benefits of true geographic diversification. It can lead to mispricing, where areas with lower risk subsidize areas with higher risk, or vice versa, and does not provide the detailed insights regulators expect for assessing portfolio resilience. A further incorrect approach would be to adopt a modeling technique that is overly complex and data-intensive, requiring assumptions that are not supported by available data or are highly subjective. While aiming for precision, this can lead to a false sense of accuracy and may not be practically implementable or auditable by regulators. The regulatory expectation is for models to be sound, justifiable, and transparent, not necessarily the most theoretically advanced if they lack empirical grounding. Professionals should approach this by first understanding the specific regulatory expectations for risk modeling and capital adequacy within their jurisdiction. They should then evaluate available modeling techniques based on their ability to define relevant events, incorporate granular geographic data, and quantify the impact of diversification. The chosen method should be a pragmatic balance between sophistication and data availability, with clear documentation of assumptions and limitations. A robust internal validation process and regular review of model performance against actual losses are crucial for demonstrating compliance and continuous improvement. Question 8. Cost-benefit analysis shows that a potential cedent has a strong track record of profitability and a significant market share. However, recent industry reports indicate increased regulatory scrutiny on the cedent's capital management practices, and its latest solvency ratio is at the lower end of the acceptable regulatory range. Which approach best aligns with the regulatory framework for evaluating the cedent's financial strength and stability? Option A. Rely on the cedent's reputation and market share as sufficient indicators of financial strength, without requiring extensive financial statement analysis or investigation into regulatory issues. Option B. Proceed with the reinsurance treaty based on the cedent's historical profitability and market leadership, assuming that these factors indicate inherent financial stability. Option C. Conduct a detailed review of the cedent's capital adequacy, liquidity position, and the specific nature of the regulatory concerns, while also considering the profitability and market position as supporting factors. Option D. Focus primarily on the potential premium volume and the immediate profitability of the proposed treaty, deferring a deep dive into financial stability concerns until after the agreement is in place. The correct answer is C. Conduct a detailed review of the cedent's capital adequacy, liquidity position, and the specific nature of the regulatory concerns, while also considering the profitability and market position as supporting factors. Explanation. This scenario is professionally challenging because evaluating a cedent's financial strength and stability is a critical component of prudent reinsurance underwriting and risk management. It requires a nuanced understanding of financial statements, market conditions, and regulatory expectations to ensure the reinsurer is not exposed to undue counterparty risk. The judgment required stems from the forward-looking nature of financial stability assessment and the potential for significant financial loss if a cedent fails. The correct approach involves a comprehensive review of the cedent's financial statements, including solvency margins, liquidity ratios, profitability trends, and capital adequacy, in conjunction with an assessment of its business strategy, market position, and management quality. This holistic evaluation is mandated by regulatory frameworks that require reinsurers to conduct thorough due diligence on their counterparties to protect policyholders and maintain the solvency of the insurance market. Specifically, regulations often require reinsurers to assess the financial strength of their cedents to ensure that the ceded business does not unduly weaken the reinsurer's own financial position. This aligns with the principle of prudent risk management and the regulatory duty to ensure that insurance and reinsurance operations are conducted in a sound and solvent manner. An incorrect approach that focuses solely on the cedent's historical profitability without considering its current liquidity and future solvency would be professionally unacceptable. This fails to address the immediate risk of counterparty default, which could lead to significant financial losses for the reinsurer and potential disruption to the market. Such an approach would violate regulatory requirements for ongoing financial strength assessment and prudent risk management, as it ignores critical indicators of financial distress. Another incorrect approach that relies solely on the cedent's reputation or market share, without substantiating it with financial data, is also professionally flawed. A reputation and market position can be indicators of stability. They are not substitutes for rigorous financial analysis. Regulatory bodies expect reinsurers to base their decisions on objective financial evidence, not merely on qualitative assessments that lack empirical support. This approach risks overlooking underlying financial weaknesses that could jeopardize the reinsurer's own financial health. Finally, an approach that prioritizes the potential for premium volume over a thorough financial strength assessment would be a serious regulatory and ethical failure. This demonstrates a disregard for the fundamental principle of counterparty risk management, where the financial viability of the cedent is paramount. Regulatory frameworks explicitly prohibit reinsurers from entering into agreements that expose them to unacceptable levels of risk, regardless of the potential for immediate profit. A professional decision-making process for similar situations should involve a structured due diligence framework that integrates financial analysis, business assessment, and regulatory compliance. This framework should prioritize the identification and mitigation of counterparty risk, ensuring that any reinsurance arrangement is entered into with a financially sound and stable cedent. Professionals must maintain an objective and critical perspective, always adhering to regulatory mandates and ethical obligations to protect the interests of their own organization and the broader insurance market. Question 9. Quality control measures reveal that a reinsurer has applied a single, uniform accounting treatment for a complex quota share reinsurance contract across its statutory filings, its U.S. GAAP financial statements, and its IFRS-compliant reports. Which of the following approaches best reflects the required adherence to accounting principles for this scenario? Option A. Prepare separate and distinct accounting treatments for the reinsurance contract, meticulously adhering to the specific requirements of statutory accounting principles, SAP for solvency, U.S. Generally Accepted Accounting Principles, GAAP for financial reporting, and International Financial Reporting Standards, IFRS for global reporting. Option B. Utilize a simplified, generalized approach to reinsurance accounting that is broadly acceptable across different accounting standards, prioritizing ease of reporting. Option C. Apply the accounting treatment prescribed by U.S. Generally Accepted Accounting Principles, GAAP, to all reporting, as it represents a robust framework for economic substance. Option D. Adopt the accounting treatment mandated by International Financial Reporting Standards, IFRS, for all reporting, as it is the most comprehensive and globally recognized standard. The correct answer is A. Prepare separate and distinct accounting treatments for the reinsurance contract, meticulously adhering to the specific requirements of statutory accounting principles, SAP for solvency, U.S. Generally Accepted Accounting Principles, GAAP for financial reporting, and International Financial Reporting Standards, IFRS, for global reporting. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a reinsurer to reconcile differing accounting treatments for the same reinsurance contract across multiple regulatory and reporting frameworks. The challenge lies in ensuring compliance with each specific framework while maintaining the integrity of financial reporting and demonstrating a clear understanding of the nuances between statutory accounting principles, SAP, Generally Accepted Accounting Principles, GAAP, and International Financial Reporting Standards, IFRS, as they apply to reinsurance. Misinterpreting or misapplying these standards can lead to regulatory sanctions, inaccurate financial statements, and a loss of stakeholder confidence. Correct approach analysis. The correct approach involves recognizing that each accounting framework, SAP, GAAP, IFRS, has distinct rules for recognizing and measuring reinsurance. For SAP, the focus is on solvency and regulatory compliance, often leading to more conservative accounting. GAAP, particularly in the U.S., emphasizes fair value and economic substance. IFRS, used globally, also focuses on economic substance, but may have different recognition and measurement criteria than U.S. GAAP. Therefore, the correct approach is to prepare separate financial reporting for each framework, ensuring that the specific requirements of SAP for solvency, GAAP for U.S. reporting, and IFRS for international reporting are meticulously followed. This demonstrates an understanding that a single accounting treatment is not universally applicable, and that compliance with each jurisdiction's specific rules is paramount. Incorrect approach is analysis, an approach that attempts to apply a single, generalized accounting standard across all frameworks is incorrect. This fails to acknowledge the fundamental differences in objectives and rules between SAP, solvency-focused, GAAP, U.S.-centric economic substance, and IFRS, global economic substance. For instance, treating all reinsurance premiums and claims identically under SAP and IFRS would likely violate the specific solvency requirements of SAP or the economic substance principles of IFRS. Another incorrect approach would be to prioritize one framework, e.g., GAAP, and apply its principles to all reporting without considering the specific mandates of the other frameworks. This would lead to non-compliance with SAP, which has unique rules for reserving and premium deferral designed to protect policyholders, and non-compliance with IFRS if its specific recognition and measurement criteria are not met. Finally, an approach that ignores the distinct nature of reinsurance accounting under each framework and simply uses a best guess or a simplified method would be professionally unacceptable. This demonstrates a lack of due diligence and a failure to adhere to established accounting principles, risking material misstatements and regulatory scrutiny. Professional reasoning. Professionals must first identify the specific regulatory and reporting frameworks applicable to the reinsurance contract. This involves understanding the domicile of the ceding insurer, the reinsurer, and the intended reporting audience. Next, they must consult the authoritative guidance for each framework e.g., NAICS, FASB, GAAP, IASB, IFRS, concerning reinsurance accounting. The core principle is to apply the rules of each framework independently and accurately. This requires a deep understanding of the differences in recognition, measurement, and disclosure requirements. When faced with discrepancies, professionals should document their rationale for each accounting treatment, ensuring transparency and auditability. This systematic approach ensures compliance, accuracy, and the ability to explain the financial position of the reinsurance contract under each relevant standard. Question 10. Market research demonstrates that a reinsurer is reviewing its case reserve and incurred, but not reported IBNR, reserve estimation processes for a portfolio of long-tail casualty business. The reinsurer is considering adopting a new approach that emphasizes the use of industry-wide average loss development factors, adjusted only by a broad economic indicator, to establish its IBNR reserves. While case reserves will be set based on the ceding insurer's stated loss adjustment expense ratios. Which of the following approaches best aligns with sound actuarial principles and regulatory expectations for reserve adequacy? Option A. Relying primarily on management's qualitative assessment of future claim trends with minimal reliance on historical data to establish both case and IBNR reserves. Option B. Utilizing actuarial methods that incorporate specific historical loss development patterns for the reinsurer's book of business, supplemented by judgmental adjustments for known deviations, and supported by detailed actuarial analysis of case reserve adequacy. Option C. Adopting industry-wide average loss development factors, adjusted solely by a broad economic indicator, for IBNR reserves, and setting case reserves based on the ceding insurer's stated loss adjustment expense ratios. Option D. Applying a fixed percentage reduction to all prior year loss development factors to accelerate reserve discounting and reduce current reserve requirements. The correct answer is B. Utilizing actuarial methods that incorporate specific historical loss development patterns for the reinsurer's book of business, supplemented by judgmental adjustments for known deviations, and supported by detailed actuarial analysis of case reserve adequacy. Explanation. This scenario is professionally challenging because it requires a reinsurer to balance the need for accurate and timely reserving with the potential for competitive pressure to present a more favorable financial picture. The core tension lies in the inherent uncertainty of estimating future claims, particularly for claims that have occurred but have not yet been reported IBNR. Regulatory frameworks, such as those governing the Reinsurance Principles and Practices exam, mandate that insurers and reinsurers establish adequate reserves to meet their future obligations. Failure to do so can lead to solvency issues and harm policyholders and other stakeholders. The choice of actuarial methods for estimating case reserves and IBNR is critical, as different methods can yield significantly different reserve amounts. A professional must select methods that are appropriate for the specific lines of business, data available, and the underlying risk characteristics, and must be able to justify their choices to regulators and auditors. The correct approach involves selecting and applying actuarial methods that are statistically sound, data-driven, and reflective of the best available information regarding claim development patterns and ultimate claim costs. This typically means using methods that consider historical data, industry trends, and specific knowledge of the business being reinsured. For Ibner, methods like the chain ladder method, Bornhueter-Ferguson method, or frequency-severity methods, when applied appropriately and with due consideration for their limitations and assumptions, are standard. The regulatory expectation is that reserves are neither understated nor overstated, but rather represent a reasonable estimate of ultimate liability. This principle is rooted in the need for financial stability and the protection of the insurance and reinsurance markets. An approach that relies solely on management's subjective judgment or targets set by the ceding company, without robust actuarial support, is professionally unacceptable. This fails to meet the regulatory requirement for actuarial soundness and can lead to inadequate reserves, potentially masking underlying financial weaknesses. Similarly, an approach that consistently applies a single, simplistic method without considering its suitability for the specific book of business, or without adjusting for known deviations from historical patterns, would also be a failure. This demonstrates a lack of due diligence and an abdication of the professional responsibility to employ appropriate actuarial techniques. Overly aggressive assumptions, even if technically derived from a recognized method, can also be problematic if they are not supported by evidence and are used to artificially reduce reserve requirements, thereby violating the principle of adequacy. The professional decision-making process for such situations should involve a thorough understanding of the business being reinsured, a critical evaluation of the available data, a selection of appropriate actuarial methodologies with a clear understanding of their assumptions and limitations, and a robust documentation of the reserving process and the rationale behind the chosen estimates. Professionals must be prepared to defend their reserve opinions based on actuarial principles and regulatory requirements, and to adjust their estimates as new information becomes available. Question 11. Research into a newly identified, rapidly evolving environmental peril reveals a potential for significant, widespread property damage. Historical loss data for this specific peril is virtually non-existent. A reinsurer is tasked with developing a pricing and capacity strategy for treaties covering this exposure. Which of the following approaches best aligns with sound reinsurance principles and regulatory expectations for exposure analysis and loss estimation in such a novel situation? Option A. Employing a combination of advanced scientific modeling, expert judgment, and scenario analysis to estimate potential loss frequency and severity, while acknowledging and quantifying inherent uncertainties. Option B. Utilizing a generic, off-the-shelf catastrophe modeling platform without specific calibration or adaptation to the unique scientific characteristics and potential triggers of the new environmental peril. Option C. Discounting the peril's potential impact due to the absence of direct historical loss experience, and therefore not significantly adjusting current underwriting guidelines, pricing for this specific exposure. Option D. Relying exclusively on historical loss data from past natural catastrophes that share some superficial similarities with the new peril, assuming similar loss patterns will emerge. The correct answer is A. Employing a combination of advanced scientific modeling, expert judgment, and scenario analysis to estimate potential loss frequency and severity, while acknowledging and quantifying inherent uncertainties. Explanation. This scenario is professionally challenging because it requires a reinsurer to assess potential future losses from a novel and rapidly evolving peril. The lack of historical data for this specific hazard necessitates a reliance on forward-looking analytical techniques and expert judgment, rather than purely empirical methods. The core challenge lies in balancing the need for a robust risk assessment with the inherent uncertainties of a new and unpredictable threat, ensuring that pricing and capacity decisions are both adequate for the reinsurer and competitive for the cedent. The correct approach involves a multifaceted exposure analysis that combines hazard identification with forward-looking loss frequency and severity estimation. This entails leveraging scientific modeling, expert opinion, and scenario analysis to project potential impacts. Regulatory frameworks, such as those governing solvency and risk management for insurers and reinsurers, mandate that firms maintain adequate capital to cover their risks. This approach directly addresses that requirement by attempting to quantify potential future losses, even in the absence of direct historical data. It aligns with the principle of prudent risk management, which requires proactive identification and assessment of all material risks, including emerging ones. Ethical considerations also play a role. A failure to adequately assess and price for emerging risks could lead to financial instability, impacting policyholders and the broader financial system. An incorrect approach would be to solely rely on historical data from similar, but not identical, perils. This fails to acknowledge the unique characteristics of the new hazard and its potential for different loss patterns. Regulatory failure here lies in not conducting a sufficiently thorough risk assessment as required by prudential regulations. It demonstrates a lack of due diligence in understanding the specific exposures being underwritten. Another incorrect approach would be to dismiss the peril due to a lack of direct historical loss experience, assuming it poses no significant risk. This is a critical failure in hazard identification and exposure analysis. Regulatory frameworks require proactive risk identification, and ignoring a known potential hazard, even without historical data, is a violation of this principle. It also represents an ethical lapse by potentially exposing the reinsurer to unforeseen and unmanaged liabilities. A third incorrect approach would be to use a simplified, generic catastrophe modeling approach that does not adequately account for the specific scientific understanding of the new peril. While modeling is necessary, a generic application without tailoring to the unique characteristics of the hazard would lead to inaccurate estimations of frequency and severity. This falls short of the regulatory expectation for a robust and specific risk assessment, potentially leading to underpricing or inadequate capital allocation. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly identify and understand the hazard, including its scientific basis and potential triggers. Second, gather all available relevant data, including scientific research, expert opinions, and analogous peril data. Third, employ appropriate analytical tools, such as advanced modeling techniques and scenario planning. Estimate potential loss frequency and severity, acknowledging the inherent uncertainties. Fourth, critically evaluate the results of the analysis, considering the limitations of the data and models. Finally, document the entire process, including assumptions and judgments, to ensure transparency and accountability, and to inform capital allocation and pricing decisions in compliance with regulatory requirements. Question 12. To address the challenge of ensuring a reinsurance arrangement is recognized for solvency credit by the ceding insurer's regulator, which approach best aligns with regulatory compliance principles for the Reinsurance Principles and Practices exam, assuming the ceding insurer is domiciled in the United States and regulated by state insurance departments. Option A. Structuring the reinsurance contract to meet the specific requirements for solvency credit as defined by the National Association of Insurance Commissioners, NAIC, Accounting Practices and Procedures Manual, AP&P Manual, and relevant state insurance codes, ensuring the reinsurer meets NAIC accreditation standards or provides acceptable collateral. Option B. Implementing a standard reinsurance contract that is widely used in the international reinsurance market, assuming it will be acceptable to U.S. state regulators. Option C. Focusing primarily on the reinsurer's domicile's regulatory requirements for reinsurance, as this dictates the reinsurer's own financial reporting and solvency. Option D. Relying on the general understanding of reinsurance as a risk transfer mechanism without verifying specific state-level solvency recognition criteria. The correct answer is A. Structuring the reinsurance contract to meet the specific requirements for solvency credit as defined by the National Association of Insurance Commissioners, NAIC, Accounting Practices and Procedures Manual, AP&P Manual, and relevant state insurance codes, ensuring the reinsurer meets NAIC accreditation standards or provides acceptable collateral. Explanation. The scenario presents a professional challenge because it requires a reinsurer to navigate the complexities of regulatory compliance across different jurisdictions, specifically concerning the reporting and solvency requirements for reinsurance arrangements. The core difficulty lies in ensuring that the chosen reinsurance structure not only meets the business objectives of risk transfer, but also adheres strictly to the solvency and reporting mandates of the primary regulator overseeing the ceding insurer, while also considering the implications for the reinsurer's own regulatory obligations in its domicile. Misinterpreting or neglecting these requirements can lead to significant financial penalties, reputational damage, and potential disruption to the ceding insurer's ability to operate. Careful judgment is required to balance these competing demands. The correct approach involves a thorough understanding and application of the specific regulatory framework governing reinsurance within the ceding insurer's jurisdiction. This means identifying and adhering to the solvency capital requirements, reporting obligations, and any specific rules regarding the recognition of reinsurance for solvency purposes, as stipulated by the relevant regulatory body. For instance, if the ceding insurer is domiciled in a jurisdiction that requires specific collateralization or approval for certain types of reinsurance to be recognized for solvency credit, the reinsurer must ensure these conditions are met. This approach is correct because it directly addresses the primary regulatory concern, ensuring the financial soundness and stability of the ceding insurer by accurately reflecting its risk profile and capital adequacy. Adherence to the ceding insurer's regulatory framework is paramount for the reinsurance to be effective from a solvency perspective and to avoid regulatory censure for both parties. An incorrect approach would be to prioritize the reinsurer's domicile regulations exclusively. While the reinsurer must comply with its own home regulator, this does not absolve it from understanding and facilitating compliance with the ceding insurer's regulatory environment, especially when the reinsurance is intended to impact the ceding insurer's solvency. Focusing solely on the reinsurer's domicile might lead to a reinsurance structure that is not recognized by the ceding insurer's regulator, rendering the risk transfer ineffective for solvency purposes and potentially creating compliance issues for the ceding insurer. Another incorrect approach would be to assume that a standard reinsurance contract automatically satisfies all regulatory requirements without specific due diligence. Regulations often have nuanced requirements regarding contract wording, the nature of the risk transfer, and the financial standing of the reinsurer. Failing to verify that the specific contract and the reinsurer's capabilities meet these detailed requirements can lead to noncompliance. A further incorrect approach would be to rely on industry best practices or general market norms without confirming their alignment with the specific regulatory mandates of the ceding insurer's jurisdiction. While industry practices can be informative, they are not a substitute for explicit regulatory compliance. What is common practice may not be compliant in a particular regulatory regime. The professional decision-making process for similar situations should involve a proactive and collaborative approach. Professionals should first identify the domicile of the ceding insurer and thoroughly research its specific reinsurance regulations, particularly those pertaining to solvency and reporting. This should be followed by an assessment of how the proposed reinsurance arrangement aligns with these requirements. Engaging with legal and compliance experts familiar with the ceding insurer's jurisdiction is crucial. The reinsurer should then communicate clearly with the ceding insurer about any potential regulatory hurdles and work collaboratively to structure the reinsurance in a compliant manner. The ultimate goal is to ensure that the reinsurance provides genuine economic benefit and risk transfer, while meeting all applicable regulatory obligations for both parties. Question 13. Analysis of an ethical dilemma arises when a reinsurer reviews a claim under a treaty that includes an inuring reinsurance clause. The treaty's basis of settlement is actual loss sustained. However, the underlying facultative reinsurance policy, which is intended to inure to the benefit of the treaty, has a basis of settlement of loss paid. The facultative reinsurer has not yet paid the claim, but the cedent argues that the treaty's inuring reinsurance clause should reduce the treaty's liability, as if the facultative reinsurance had already been paid. What is the most appropriate course of action for the treaty reinsurer? Option A. Acknowledge the facultative reinsurance as inuring, but defer any reduction in the treaty's liability until the facultative reinsurer has actually paid the claim, in accordance with the facultative policy's basis of settlement. Option B. Treat the facultative reinsurance as irrelevant to the treaty's current liability, as its basis of settlement differs, and pay the claim in full under the treaty. Option C. Interpret the facultative reinsurance as automatically adopting the treaty's actual loss sustained basis of settlement, thereby allowing an immediate reduction in the treaty's liability. Option D. Immediately reduce the treaty's liability based on the potential recovery from the facultative reinsurance, assuming the facultative reinsurer will eventually pay. The correct answer is A. Acknowledge the facultative reinsurance as inuring, but defer any reduction in the treaty's liability until the facultative reinsurer has actually paid the claim, in accordance with the facultative policy's basis of settlement. Explanation. This scenario presents a professional challenge due to the inherent conflict between a reinsurer's desire to limit its exposure and a cedent's need for clear, unambiguous coverage. The specific challenge lies in interpreting the intent and application of an inuring reinsurance clause when the underlying facultative reinsurance policy has a different basis of settlement than the primary treaty. This requires careful judgment to ensure that the reinsurer's obligations are accurately reflected, and that the cedent receives the intended benefit of the inuring coverage without creating unintended loopholes or disputes. The correct approach involves a thorough review of the facultative reinsurance policy's terms and conditions, specifically focusing on its basis of settlement and any exclusions or limitations that might affect its applicability to the treaty's claims. It also requires understanding how the inuring reinsurance clause in the treaty is intended to interact with such underlying policies. The professional and ethical obligation is to interpret the clauses in a manner that upholds the spirit of the reinsurance contract, ensuring that the cedent is not prejudiced by the existence of the inuring reinsurance, and that the reinsurer's liability is correctly determined according to the agreed-upon terms. This aligns with the principle of utmost good faith, requiring transparency and fair dealing between parties. An incorrect approach would be to unilaterally interpret the inuring reinsurance clause in a way that automatically reduces the treaty's liability based on the existence of the facultative reinsurance, without first confirming that the facultative policy's terms and basis of settlement actually permit such an offset or reduction under the treaty's specific circumstances. This could lead to a breach of contract if the facultative policy does not operate in the manner assumed. Another incorrect approach would be to ignore the facultative reinsurance entirely, treating it as irrelevant to the treaty's obligations, which would also be a failure to adhere to the agreed-upon inuring reinsurance clause, and could lead to disputes and potential financial loss for the cedent. A third incorrect approach would be to assume the facultative reinsurance is follow the fortunes, or follow the settlements of the primary treaty without explicit contractual language to that effect, as this could expose the reinsurer to liabilities it did not contractually agree to assume. Professionals should approach such situations by first identifying the specific contractual clauses in question, the inuring reinsurance clause in the treaty, and the relevant terms of the facultative policy. They should then seek to understand the intent of these clauses in the context of the overall agreement. If ambiguity exists, the professional should consult with legal counsel specializing in reinsurance and engage in open communication with the cedent to clarify the intended application of the clauses. The decision-making process should prioritize contractual integrity, adherence to the principles of utmost good faith, and the avoidance of disputes through clear and accurate interpretation of the reinsurance agreements. Question 14. The investigation demonstrates that a U.S. domiciled cedent has entered into a reinsurance agreement with a Bermuda domiciled reinsurer. The agreement includes a service of suit clause that requires the reinsurer to designate an agent for service of process in New York. The cedent has received confirmation that the reinsurer has appointed its legal department as the agent for service of process. The cedent's legal counsel is concerned about the practical implications of this designation for initiating legal action in New York. Which of the following actions best addresses the cedent's concern regarding the service of suit clause? Option A. Proceed with initiating legal action by serving the Bermuda domiciled reinsurer directly in Bermuda, assuming that international treaties will facilitate service. Option B. Advise the cedent to waive the service of suit clause to avoid potential disputes over the adequacy of the appointed agent. Option C. Insist that the reinsurer appoint a specific individual or a designated third-party service company in New York as the agent for service of process, with clear contact information and a process for prompt forwarding of legal documents. Option D. Accept the designation of the legal department as the agent for service of process, as it is a recognized entity within the reinsurer's organization. The correct answer is D. Accept the designation of the legal department as the agent for service of process, as it is a recognized entity within the reinsurer's organization. Explanation: the investigation demonstrates a common challenge in international reinsurance, ensuring effective legal recourse when disputes arise. The core of this challenge lies in the practicalities of cross-border litigation and the need for a clear, accessible point of contact for legal proceedings. A service of suit clause is designed to address this by requiring the reinsurer to designate an agent for service of process within a specific jurisdiction. This clause is crucial for the cedent to be able to initiate and pursue legal action against the reinsurer without undue difficulty or delay, particularly if the reinsurer is domiciled in a different country. The professional challenge arises from correctly interpreting the scope and implications of such a clause, especially when the reinsurer attempts to circumvent its obligations or when the designated agent is no longer suitable or available. The correct approach involves the cedent ensuring that the reinsurer has indeed appointed a reliable and accessible agent for service of process in the agreed-upon jurisdiction, and that this agent is capable of receiving and forwarding legal documents promptly. This aligns with the fundamental principle of ensuring enforceability of the reinsurance contract and providing the cedent with a practical means of dispute resolution. Regulatory frameworks, such as those governing insurance and reinsurance in the United States, which is the assumed jurisdiction for this exam based on common exam content, often emphasize the importance of clear contractual terms that facilitate legal action and protect policyholders and their reinsurers. The service of suit clause is a key mechanism for achieving this, ensuring that a reinsurer operating internationally cannot evade legal accountability by being geographically distant. An incorrect approach would be to accept a vague or nonspecific designation of an agent, or to allow the reinsurer to appoint an agent that is not readily accessible or demonstrably capable of handling legal service. For instance, designating a general legal department of the reinsurer without a specific individual or process for receiving legal documents could lead to delays or outright failure to receive notice, thereby undermining the purpose of the clause. Another incorrect approach would be to permit the reinsurer to argue that service on a foreign entity is sufficient, thereby attempting to bypass the agreed-upon mechanism for service of suit. Such actions would contravene the spirit and intent of the service of suit clause, which is to provide a clear and efficient pathway for legal action within a defined jurisdiction, thereby potentially exposing the cedent to significant legal and financial risks. Regulatory bodies would view such attempts to circumvent contractual obligations as a failure to uphold the integrity of the reinsurance contract, and potentially as an unfair practice. Professionals must therefore meticulously verify the adequacy of the designated agent and the reinsurer's commitment to the clause's provisions. The professional decision-making process for similar situations should involve a thorough review of the reinsurance contract, paying close attention to the service of suit clause and its specific requirements. This includes identifying the designated jurisdiction and the nature of the agent appointed. If there is any ambiguity or concern about the effectiveness of the appointed agent, the professional should proactively seek clarification from the reinsurer and, if necessary, insist on a more suitable appointment. This proactive approach, grounded in a clear understanding of contractual obligations and regulatory expectations, is essential for mitigating risks and ensuring that legal recourse is readily available when needed. Question 15. During the evaluation of a facultative reinsurance claim, the cedent provides initial notification of a significant loss approximately 48 hours after the agreed-upon contractual deadline. Subsequently, the cedent submits the required supporting documentation, but it is incomplete, with several key pieces of information missing, and this submission also occurs several days beyond the stipulated timeframe for documentation. The reinsurer is considering its response. Which of the following approaches best aligns with the regulatory framework for reinsurance principles and practices in this jurisdiction? Option A. Accept the claim without further comment or follow-up, assuming the cedent will rectify any issues in the future. Option B. Engage in a dialogue with the cedent to understand the reasons for the delays and missing documentation, while clearly reiterating the contractual obligations and seeking prompt submission of all required information to proceed with the claim evaluation. Option C. Immediately reject the claim due to the cedent's failure to meet both the notification and documentation deadlines, citing breach of contract. Option D. Issue a formal notice of non-compliance to the cedent, demanding immediate submission of all outstanding documentation within 24 hours, with a threat of further action if not met. The correct answer is C. Immediately reject the claim due to the cedent's failure to meet both the notification and documentation deadlines, citing breach of contract. Explanation: this scenario presents a professional challenge due to the inherent tension between the reinsurer's need for timely and accurate information to manage its liabilities and the cedent's operational realities, which can sometimes lead to delays or incomplete initial reporting. The core of the challenge lies in balancing the contractual obligations for prompt notification and documentation with the practicalities of claims handling, while strictly adhering to the regulatory framework governing reinsurance in the specified jurisdiction. Careful judgment is required to ensure compliance without unduly penalizing the cedent or compromising the reinsurer's ability to assess and reserve for claims. The correct approach involves a proactive and collaborative communication strategy that prioritizes adherence to the documented notification and documentation protocols outlined in the reinsurance agreement, while also seeking to understand and address any underlying reasons for delays. This approach aligns with regulatory expectations for diligent claims handling and reporting, emphasizing the importance of clear communication channels and the timely submission of required documentation as stipulated by the contract and relevant regulations. It recognizes that, while strict adherence to timelines is crucial, a constructive dialogue can often resolve issues and prevent future noncompliance, ultimately serving the best interests of both parties and regulatory oversight. An incorrect approach that involves immediate rejection of the claim solely based on a minor delay in initial notification, without further investigation or communication, fails to acknowledge the potential for extenuating circumstances and the importance of a reasonable and proportionate response. This can lead to regulatory scrutiny for failing to act in good faith or for imposing punitive measures not explicitly supported by the contract or regulatory guidance. Another incorrect approach, which is to accept the claim without any follow-up on the missing documentation and without reinforcing the importance of timely reporting, creates a precedent for future noncompliance and exposes the reinsurer to potential adverse selection or inadequate reserving. This undermines the principles of sound reinsurance practice and can be viewed as a failure to exercise due diligence, potentially contravening regulatory requirements for robust internal controls and risk management. A further incorrect approach, which is to communicate solely through formal, adversarial channels without attempting to understand the cedent's operational challenges, can damage the business relationship and hinder effective claims resolution. While formal communication is necessary, an overly rigid stance without seeking to understand and address the root cause of reporting issues can be seen as unprofessional and may not align with the spirit of regulatory expectations for cooperative market conduct. The professional decision-making process for similar situations should involve a thorough review of the reinsurance contract's specific clauses on notification and documentation. This should be followed by an assessment of the materiality of the delay or deficiency, considering the impact on the reinsurer's ability to assess the claim. Open and clear communication with the cedent to understand the reasons for any noncompliance is paramount. If the noncompliance is minor and rectifiable, a collaborative approach to ensure future adherence is appropriate. If the noncompliance is significant or persistent, escalation and potential application of contractual remedies in line with regulatory guidance may be necessary. The overarching principle is to act diligently, in good faith, and in compliance with all applicable regulations and contractual terms. Question 16. Risk assessment procedures indicate that a facultative reinsurance contract is being negotiated between a U.S. domiciled cedent and a reinsurer. The cedent's legal department has proposed that the contract be governed by the laws of a jurisdiction outside the United States, citing potential efficiencies in dispute resolution. What is the most prudent approach for the cedent to take regarding the governing law clause? Option A. Accept the proposed governing law but include a clause that allows for arbitration in a U.S. state, believing this mitigates most risks. Option B. Insist on the governing law of a U.S. state, preferably the state in which the cedent is domiciled, to ensure alignment with familiar regulatory and legal principles. Option C. Agree to the proposed governing law, assuming that efficiencies in dispute resolution will outweigh any potential legal complexities. Option D. Propose a neutral offshore jurisdiction with a reputation for sophisticated commercial law, without conducting further due diligence on its specific application to reinsurance. The correct answer is C. Agree to the proposed governing law, assuming that efficiencies in dispute resolution will outweigh any potential legal complexities. Explanation. This scenario presents a professional challenge because the governing law clause in a reinsurance contract is a critical element that dictates how disputes will be resolved and which legal principles will apply. Misinterpreting or misapplying this clause can lead to significant financial and legal repercussions for both the cedent and the reinsurer. The challenge lies in ensuring that the chosen jurisdiction and its associated legal principles are not only commercially sensible, but also compliant with the regulatory expectations of the relevant supervisory authorities, particularly concerning the enforceability of reinsurance contracts and the protection of policyholders. Correct approach involves carefully considering the implications of the chosen governing law on the interpretation and enforceability of the reinsurance contract. This includes understanding how the courts in that jurisdiction typically handle reinsurance disputes, the availability of legal remedies, and any specific statutory provisions that might impact the contract. For a U.S. regulated exam, this means aligning with U.S. insurance and contract law principles and potentially state-specific regulations that govern reinsurance. The regulatory framework for reinsurance in the U.S. emphasizes the solvency of insurers and the protection of policyholders, and the governing law clause must not undermine these objectives. Choosing a jurisdiction whose laws are well understood and predictable, and which does not create undue barriers to the enforcement of reinsurance obligations, is paramount. An incorrect approach would be to select a governing law based solely on convenience or perceived cost savings, without a thorough understanding of its legal implications. For instance, choosing a jurisdiction with unfamiliar or overly complex legal procedures could lead to protracted and expensive litigation, potentially exposing the parties to unforeseen liabilities. Another incorrect approach would be to select a jurisdiction whose laws are known to be unfavorable to the enforcement of reinsurance contracts, or that might conflict with U.S. regulatory requirements for admitted reinsurers or the treatment of reinsurance in solvency calculations. This could lead to regulatory scrutiny and potential penalties. A further incorrect approach would be to ignore the potential impact of the governing law on the interpretation of specific contract terms, such as claims handling or dispute resolution mechanisms, leading to disputes that could have been avoided with proper foresight. The professional decision-making process for similar situations should involve a multidisciplinary team, including legal counsel with expertise in reinsurance and the relevant jurisdictions, as well as experienced underwriting and claims personnel. This team should conduct a comprehensive risk assessment of potential governing law clauses, considering factors such as legal precedent, regulatory environment, enforceability, and potential impact on business operations. The decision should be documented, with clear rationale supporting the chosen jurisdiction and legal principles, ensuring transparency and accountability. Question 17. The performance metrics show a significant increase in the frequency of small to medium-sized claims within the cedent's property portfolio, alongside a lower-than-expected impact from large catastrophic events over the past 3 years. The cedent is seeking reinsurance to stabilize its underwriting results and protect its surplus from the accumulating impact of these frequent claims. Which of the following approaches best aligns with the identified risks and the function of reinsurance in this context? Option A. Utilizing a stop-loss reinsurance treaty that covers aggregate losses exceeding a predetermined percentage of earned premiums. Option B. Securing a catastrophe excessive loss treaty that provides coverage only for losses exceeding a high retention threshold. Option C. Arranging a facultative reinsurance placement for each individual large claim that exceeds a moderate threshold. Option D. Implementing a proportional reinsurance treaty that cedes a fixed percentage of all premiums and losses for the property portfolio. The correct answer is D. Implementing a proportional reinsurance treaty that cedes a fixed percentage of all premiums and losses for the property portfolio. Explanation. This scenario is professionally challenging because it requires a reinsurer to balance the need for accurate risk assessment with the practicalities of securing reinsurance coverage. The reinsurer must ensure that the proposed reinsurance structure aligns with the cedent's risk profile and business objectives, while also adhering to regulatory requirements for solvency and capital adequacy. The complexity arises from identifying the most appropriate reinsurance type and function that effectively transfers the specific risks identified in the performance metrics without creating unintended consequences or regulatory breaches. The correct approach involves a thorough analysis of the cedent's performance metrics to identify the underlying risks, and then selecting a reinsurance type and function that directly addresses those risks in a compliant manner. This requires understanding the nuances of different reinsurance structures and their suitability for various risk exposures. For instance, if the performance metrics highlight volatility in claims frequency for a specific line of business, proportional reinsurance might be considered to share both premiums and losses, thereby stabilizing the cedent's results. Alternatively, if the concern is the impact of a single large loss event, non-proportional reinsurance, such as excessive loss, would be more appropriate to protect against catastrophic events. The regulatory framework for this exam emphasizes prudent risk management and the proper functioning of reinsurance as a risk transfer mechanism. Selecting a reinsurance solution that accurately reflects the risk profile and meets regulatory capital requirements is paramount. An incorrect approach would be to select a reinsurance type based solely on cost or ease of implementation, without a deep understanding of how it addresses the identified risks. For example, choosing a quota share treaty simply because it offers a broad coverage might be inappropriate if the cedent's primary concern is catastrophic loss, as quota share shares all losses, including small ones, which may not be the most efficient way to manage extreme volatility. Another incorrect approach would be to propose a reinsurance structure that, while appearing to transfer risk, does not genuinely do so in a way that satisfies regulatory principles of risk transfer, potentially leading to capital charges or regulatory scrutiny. This could involve arrangements that are more akin to financing than true risk transfer, or structures that are overly complex and obscure the underlying risk. The professional decision-making process should involve a systematic evaluation of the cedent's risk profile, as revealed by the performance metrics. This should be followed by an assessment of how different reinsurance functions, e.g., risk sharing, capacity provision, catastrophe protection, and types, e.g., proportional, non-proportional, can address these risks. The chosen solution must then be evaluated against relevant regulatory requirements, ensuring it provides genuine risk transfer and supports the cedent's financial stability and solvency. Question 18. Comparative studies suggest that a significant source of friction in reinsurance relationships stems from differing interpretations of contract clauses. In a scenario where a cedent and a reinsurer disagree on whether a series of claims constitutes a single loss occurrence, as defined in their excess of loss reinsurance treaty, what is the most appropriate course of action for the parties to resolve this dispute? Option A. The cedent should unilaterally determine the classification of the loss occurrence based on its internal claims handling guidelines, as it is the primary insurer. Option B. The parties should engage in a detailed review of the reinsurance contract's definition of loss occurrence and the factual circumstances of the claims, and if ambiguity remains, utilize the dispute resolution mechanism stipulated in the contract. Option C. The reinsurer should exert pressure on the cedent to accept a settlement that aligns with the reinsurer's initial assessment to expedite the resolution process. Option D. The reinsurer should apply its standard market interpretation of loss occurrence to the situation, as this reflects common industry practice. The correct answer is B. The parties should engage in a detailed review of the reinsurance contract's definition of loss occurrence and the factual circumstances of the claims, and if ambiguity remains, utilize the dispute resolution mechanism stipulated in the contract. Explanation. Scenario analysis. This scenario is professionally challenging because it involves a dispute over the interpretation of a reinsurance contract clause, specifically concerning the definition of loss occurrence. Such disputes can arise from differing business practices, evolving industry standards, or ambiguous contract wording. The challenge lies in objectively determining the intended meaning of the clause and applying it to the facts, which can have significant financial implications for both the reinsurer and the cedent. Navigating these disputes requires a thorough understanding of reinsurance principles, contract law, and the specific regulatory environment governing such agreements. Correct approach analysis. The correct approach involves a meticulous review of the reinsurance contract's wording, paying close attention to the definition of loss occurrence and any related clauses. This is followed by an examination of the factual circumstances surrounding the claims to determine if they align with the contractual definition. If ambiguity persists, seeking clarification through established dispute resolution mechanisms outlined in the contract, such as arbitration or mediation, is the most appropriate course of action. This approach is justified by the regulatory framework that emphasizes adherence to contractual terms and the use of agreed-upon dispute resolution processes. The principles of good faith and fair dealing, inherent in insurance and reinsurance regulation, mandate that parties attempt to resolve disputes based on the contract's provisions and through established legal or contractual channels, rather than unilateral assumptions or external pressure. Incorrect approach is analysis. Unilaterally interpreting loss occurrence based on the cedent's internal claims handling procedures without reference to the contract's specific definition is an incorrect approach. This fails to uphold the contractual agreement and violates the regulatory principle of adhering to the terms of the reinsurance contract. It also demonstrates a lack of good faith by prioritizing one party's internal processes over the agreed-upon contractual language. Adopting the reinsurer's standard market interpretation of loss occurrence without verifying its alignment with the specific wording of the contract in dispute is also an incorrect approach. While market practice can inform interpretation, it cannot override explicit contractual terms. This approach risks misapplying general principles to a specific agreement, potentially leading to a breach of contract and regulatory noncompliance. Pressuring the cedent to accept a settlement based on the reinsurer's perceived advantage, without a thorough contractual analysis or engagement in the agreed-upon dispute resolution process, is a failure of professional conduct. This approach disregards the contractual framework and the principles of fair dealing, potentially leading to regulatory sanctions for unfair claims settlement practices. Professional reasoning. Professionals should approach reinsurance contract disputes by prioritizing a thorough, objective, and contractually compliant analysis. This involves 1. Deeply understanding the specific contract wording and definitions. 2. Factually assessing the claims against the contractual definitions. 3. Engaging in good faith discussions and utilizing agreed-upon dispute resolution mechanisms. 4. Consulting legal counsel or expert advisors when necessary. This systematic process ensures adherence to regulatory requirements, upholds contractual integrity, and promotes fair outcomes. Question 19. System analysis indicates that a dispute has arisen between a cedent and a reinsurer regarding the interpretation of a specific clause in a facultative reinsurance certificate. The cedent argues that the clause, as written, provides coverage for a particular type of loss, while the reinsurer contends that the clause was intended to exclude such losses, citing discussions that occurred during the negotiation phase. The reinsurance certificate is a fully integrated agreement. Which approach best reflects the legally and regulatorily sound method for resolving this dispute, adhering strictly to the principles governing contract interpretation within the relevant jurisdiction? Option A. Prioritize the reinsurer's stated intention during negotiations, introducing evidence of those discussions to clarify the clause's meaning, even if it contradicts the plain language. Option B. Introduce evidence of prior drafts and negotiation notes to establish the intended meaning, overriding the final wording of the certificate if the evidence suggests a different intent. Option C. Focus solely on the cedent's understanding of the clause during negotiations, as they are the party seeking coverage, and interpret the clause in their favor regardless of the written wording. Option D. Interpret the clause based on the ordinary and natural meaning of the words used, and if ambiguity remains, construe the ambiguity against the reinsurer as the drafting party. The correct answer is D. Interpret the clause based on the ordinary and natural meaning of the words used, and if ambiguity remains, construe the ambiguity against the reinsurer as the drafting party. Explanation. This scenario presents a professional challenge due to the inherent ambiguity that can arise in reinsurance contracts, particularly when disputes over coverage arise. The core of the challenge lies in interpreting contractual language that may be unclear or open to multiple interpretations, requiring a nuanced application of legal principles to achieve a fair and compliant outcome. Careful judgment is required to balance the intent of the parties with the established legal doctrines governing contract interpretation. The correct approach involves prioritizing the plain meaning rule, which dictates that contractual terms should be interpreted according to their ordinary and natural meaning. If ambiguity persists after applying the plain meaning rule, the contra pro frontum rule should be considered, which states that any ambiguity in a contract will be construed against the party that drafted it. This approach is professionally sound and ethically justifiable because it upholds the principle of contractual certainty and fairness. It aligns with the regulatory expectation that contracts, including reinsurance agreements, should be interpreted in a manner that reflects the reasonable expectations of the parties and promotes dispute resolution based on established legal precedent. The plain meaning rule ensures that the language used in the contract is given its most straightforward interpretation, preventing parties from later claiming a different meaning was intended. The contra pro frontum rule acts as a safeguard against drafting deficiencies, ensuring that the party responsible for the ambiguity bears the consequence. An incorrect approach would be to solely rely on the subjective intent of one party without considering the objective language of the contract. This fails to adhere to the plain meaning rule and can lead to arbitrary interpretations that undermine contractual integrity. Such an approach is ethically problematic as it can be seen as opportunistic and unfair to the other party. Another incorrect approach would be to disregard the contra pro frontum rule when ambiguity is present and instead attempt to introduce external evidence to alter the clear meaning of the contract, thereby circumventing the parole evidence rule. The parole evidence rule generally prevents the introduction of prior or contemporaneous oral or written agreements that contradict or vary the terms of a fully integrated written contract. Ignoring this rule, especially when ambiguity exists and contra pro frontum is applicable, would be a regulatory failure. It would allow for the manipulation of contractual obligations based on potentially unreliable external information, rather than the agreed-upon written terms. This can lead to disputes, regulatory scrutiny, and a breakdown of trust within the reinsurance market. The professional decision-making process for similar situations should involve a systematic evaluation of the contractual language. First, apply the plain meaning rule to ascertain the ordinary and natural interpretation of the disputed terms. If the language remains ambiguous, then consider the contra pro frontum rule, assessing which party drafted the ambiguous provision. Throughout this process, the parole evidence rule must be respected, ensuring that any external evidence considered does not contradict or vary the terms of the written contract, unless specific exceptions apply. This structured approach ensures adherence to legal principles, regulatory expectations, and ethical conduct. Question 20. Investigation of a facultative reinsurance placement reveals a discrepancy in the final premium charged by the reinsurer. The facultative certificate includes a clause stating that the premium will be adjusted retrospectively based on the actual exposure developed during the policy period. The cedent has provided detailed reports showing a lower than anticipated exposure, leading to a lower actual risk profile than initially estimated. The reinsurer, however, is proposing to maintain the initially agreed-upon premium, citing internal risk management concerns that were not explicitly detailed in the facultative certificate. What is the most appropriate course of action for the cedent to take in this situation? Option A. Accept the reinsurer's proposed premium to maintain a positive working relationship, assuming the reinsurer's internal concerns are valid and outweigh the contractual wording. Option B. Insist on a premium adjustment in line with the actual exposure developed, as per the facultative certificate, requesting a detailed breakdown of the reinsurer's risk management concerns and how they supersede the contractual terms. Option C. Propose a compromise where a partial premium adjustment is made, acknowledging the reinsurer's concerns but also reflecting some of the reduced exposure. Option D. Seek legal counsel to understand the enforceability of the actual exposure clause and potentially initiate arbitration if the reinsurer remains unwilling to adjust the premium. Correct answer is B. Insist on a premium adjustment in line with the actual exposure developed, as per the facultative certificate, requesting a detailed breakdown of the reinsurer's risk management concerns and how they supersede the contractual terms. Explanation. This scenario presents a professional challenge due to the inherent complexities in accurately determining and adjusting reinsurance premiums, especially when dealing with retrospective adjustments based on actual experience. The challenge lies in balancing the reinsurer's need for accurate premium commensurate with risk and the cedent's need for predictable costs and efficient administration. Careful judgment is required to ensure that the chosen premium adjustment method aligns with the underlying reinsurance contract terms, applicable regulations, and ethical principles of fairness and transparency. The correct approach involves adhering strictly to the premium adjustment clause as defined in the reinsurance contract. This means understanding the specific triggers for adjustment, e.g., changes in the cedent's book of business, claims experience exceeding a certain threshold, or changes in underlying risk factors. The method for calculating the adjustment, e.g., pro rata, experience rating, or a combination, and the agreed-upon payment terms for any resulting premium adjustments. Regulatory compliance in this context would involve ensuring that the contract terms and the subsequent adjustments are consistent with the principles of sound insurance and reinsurance practice, as outlined by the relevant regulatory bodies governing the exam's jurisdiction. This approach is professionally sound because it upholds contractual integrity, ensures that the reinsurer is adequately compensated for the risk assumed, and provides a clear, auditable process for premium adjustments, thereby fostering trust and transparency between the cedent and reinsurer. An incorrect approach would be to unilaterally impose a premium adjustment based on the reinsurer's internal assessment of increased risk, without explicit contractual provision or mutual agreement. This failure stems from a disregard for the contractual agreement, which is a fundamental regulatory and ethical requirement. Another incorrect approach would be to delay or refuse to make a downward premium adjustment when the contract clearly stipulates such a provision based on favorable experience. This violates the principle of good faith and fair dealing, which is a cornerstone of regulatory oversight in the insurance and reinsurance industry. Furthermore, attempting to adjust premiums based on subjective interpretations of fairness, rather than the objective criteria laid out in the contract, constitutes a significant ethical and regulatory breach, as it undermines the predictability and certainty that reinsurance contracts are designed to provide. Professional decision-making in such situations requires a thorough review of the reinsurance contract, consultation with legal and actuarial experts if necessary, and open communication with the counterparty. The process should prioritize adherence to the agreed-upon terms, regulatory compliance, and ethical conduct, ensuring that all parties understand and agree upon the basis for any premium adjustments.